Welcome to Iron Financial, the show where we help you forge a stronger portfolio by cutting right through the market's weakness. Today, we are putting Dave & Buster's ticker symbol play directly under the microscope, and what a situation we have here. The company just dropped an absolutely catastrophic earnings report, and yet the stock actually went up. Now, that's a massive contradiction we have to break down because, understanding these moments, these paradoxes in the market is what separates truly disciplined investors from the rest of the crowd. Okay, let's just dive right into the heart of this thing. This is the central puzzle. So Wall Street expected earnings per share to be a positive 41 cents. Instead, they came in at a loss of 35 cents. That's not a miss. That's a miss of 185%. In any normal, rational market, for pretty much any normal company, that is a death sentence. A miss of that magnitude screams that there's a complete breakdown in management's ability to even forecast their own business. The stock should have imploded. It should have been a crater, but it didn't. It actually nudged up a little. So what's going on? Well, the market is seeing something that the terrible headline numbers are hiding. So our job today is to deconstruct this entire report, separate the very real structural damage from the blueprint for a rebuild, and figure out if the market is being brilliant or just completely delusional. All right, before we can even begin to understand the market's bizarre optimism, we have to do the hard part first. We have to assess the raw damage. We really need to walk through the wreckage of this earnings report and examine every single crack in this company's foundation. And trust me, the numbers are not pretty. They paint a picture of a business size under some severe stress. And look, this isn't just about one bad quarter. It's about identifying the negative trends that led them to this point in the first place. So let's get into the specifics. Now look at this slide. What's really telling here is just the sheer scale of the failure. I mean, look at that EPS line. 185% miss isn't just a rounding error. It's a fundamental, catastrophic breakdown in performance. This is the kind of number that absolutely destroys management credibility. And then look over at revenue. A miss of nearly 5%, right? They brought in $529.6 million when the street was looking for over $557 million. That's a nearly $28 million hole in their top line, just for the quarter. Now stop and think about what a company could do with an extra $28 million. That's capital for new games, it's for remodels, for debt reduction, and for them, it's just gone. These are not minor blemishes, folks. These are significant structural failures in their core business operations. And this is where I have to jump in. That massive EPS miss, it wasn't a fluke. It wasn't some one-off bad quarter caused by a snowstorm, which, by the way, they did actually try to blame for some of their poor performance. No, this negative 5% number you see here, that represents the full year decline in their comparable store sales. Let's be crystal clear about what that means. Comparable store sales, or comps as we call them, track the performance of stores that have been open for at least a year. It is the single best health metric for a retail or restaurant business. And it's telling us that, on average, their established, mature stores are bringing in 5% less money than they did the year before. This points to a systemic problem. It tells us that customer traffic is weakening, or maybe customer spending is down, or, and this is the scary one, it's both. This isn't just a crack. It's a sign that the very ground underneath the entire structure is eroding. And the market skeptic is exactly right. That decline in sales flows directly to the bottom line. And this number, a $40 million net loss in the fourth quarter alone, is the ugly result. You simply cannot sustain a business that's bleeding this much cash from its core operations. Look, a profit margin isn't some kind of luxury. It's the absolute lifeblood of a company. When your comps go negative, you lose what's called operating leverage. All your fixed costs, the rent, management salaries, utilities, they all stay the same, but you have less revenue coming in the door to cover them. Every single lost dollar of sales has an outsized, painful, negative impact on your profit. So this $40 million loss isn't just an accounting figure on a spreadsheet. It represents a fundamental failure to convert revenues into actual profit. It's the price you pay for decline in sales and a business model that is, at least for now, completely broken. And let me just translate this for everybody because it's important. Adjusted EBITDA. This is the metric that analysts look at to see the raw, operational cash-generating power of a business, because it strips out some of the accounting noise, like taxes and depreciation. But the key word there is adjusted. See, they're also stripping out things like stock-based compensation for executives. So while it can be a useful metric, it's often the most favorable view of a company's health. And even this very flattering metric fell by nearly $70 million year over year. Think of EBITDA as the engine of the company. Well, this chart shows that the engine's horsepower has been drastically cut. It's sputtering. And when your core profitability engine is failing, it becomes incredibly difficult to fund any kind of turnaround. You can't build a new structure if the machine you need to power the construction is breaking down. This is a massive, massive red flag. So let's recap. The foundation is clearly cracked. The existing structure is weak. By all accounts, this company should be on the verge of total collapse. And yet, the stock held its ground. It didn't fall apart. And the reason is that on the earnings call, management didn't just present the damage report, they came out and unveiled a blueprint for a complete and total rebuild. So now we're going to analyze that blueprint piece by piece to determine if this is a credible plan for a new, stronger foundation or if it's just a desperate sketch on the back of a napkin. Okay, this is it. This is the plan. The so-called back-to-basics strategy. This is their 4-point plan to extinguish the fire and rebuild this company from the studs up. Management has basically boiled their entire turnaround down to these 4 pillars. They believe that by revitalizing their marketing, fixing the food and beverage offering, bringing some new life to the arcade, and doubling down on operational execution and store remodels, they believe they can reverse the decline. It's a pretty comprehensive approach, touching every single part of the business. So let's deconstruct each of these pillars one by one and see if they can actually support the weight of a real turnaround. And right here, we have the first solid support beam in their new structure. While the overall business was clearly shrinking, the food and beverage segment showed some incredible strength. In fact, comparable sales in F&B were up 7% in the fourth quarter. Now, this is not a small number. It shows that their strategy here is actually working. Management admitted they made a pretty big mistake after COVID by getting too fancy and complicated with the menu. So what they do? They've since gone back to a more classic, successful pre-COVID menu focused on what their customers actually want. Great burgers, wings, and shareable appetizers. The results? They're undeniable. Customers are clearly responding. This is the first piece of hard evidence we have that management can identify a problem, create a fix, and then actually execute it successfully. Okay, hold on. A 700 basis point improvement. That's 7 full percentage points. That is impressive, I'll give them that. Getting more gamers to stay and buy food is absolutely a win. But is it enough? Let's be serious. Dave & Buster's is not a restaurant that happens to have games. It is an arcade that happens to have a restaurant. Their core business, their very identity, is amusements. So while this F&B growth is a nice, positive sign, my question is this. Can a strong food business truly carry the entire weight of a collapsing amusement business? To me, it kind of feels like they're bragging about getting a new mailbox while the entire roof is caving in. That's a really fair challenge, and what's interesting is management actually agrees with you. On the call, the CEO, Tarun Lal, was incredibly explicit about this. He said, and I'm quoting here, "We moved away from introducing new games to the system over the last 6 years. This current management team strongly believes that was a mistake." This is such a crucial admission. For 6 years, the absolute core of their business, the main reason people go there, was allowed to get stale. They basically starved their primary traffic driver. But acknowledging the problem is the first and arguably the most critical step toward fixing it. It shows that this team isn't the same team that let the business decay in the first place. And that, right there, builds a small amount of credibility with investors. And this slide? This is their proposed solution. This is the powerful countermeasure to 6 long years of neglect. They are launching the most new games in a single year since 2017. And just look at this lineup. They're not just adding a few generic arcade cabinets in the corner. They are leveraging massive, culturally relevant intellectual properties. We're talking John Wick, Stranger Things, The Mandalorian. These are brands that drive intense, passionate fan engagement. So this isn't just about refreshing the game floor. It's about creating destination experiences that will, in theory, drive traffic and directly address that core weakness in their amusement business. And the system-wide rollout of that viral human crane game, that's another really smart move, capitalizing on social media buzz to create a reason to visit that you literally can't get anywhere else. Yeah, but you know what? Confidence is cheap. A press release and a nice quote from the CEO don't automatically fix 6 years of underinvestment. Are a few licensed games, no matter how popular, really enough to reverse what seems to be a deep-seated customer fatigue? People stopped coming for a reason. They felt the arcade was stale and boring. So I want to know, how much did those big-name licenses cost? And more importantly, how many new visits and gameplays do they need to generate just to get a return on that investment? Rebuilding that excitement and convincing customers who have already left to come back, that's a monumental task. It's really easy to announce a strong lineup. It's much, much harder to execute in a way that actually moves the needle on traffic and sales. I remain very skeptical that this is the silver bullet they're presenting it as. And the skeptic's point on execution is completely valid, which is exactly why this third pillar, marketing, is so critical. You can have the best, most exciting games in the world, but if nobody knows about them, it just doesn't matter. This slide right here shows the shift they're making from what seems like a chaotic, ineffective post-COVID strategy to a new, disciplined, data-driven approach. They're no longer just throwing money at the wall and hoping something sticks. They are creating culturally relevant promotions. For example, their Valentine's Day human crane giveaway generated 6 billion impressions online. 6 billion! They also turned the Super Bowl, which is traditionally one of their worst days of the year, into a highly productive one with special ticketed events. They're methodically rebuilding brand consideration and using a much smarter media mix to make sure their message about new games and better food actually reaches potential customers. It's about surgical strikes, not carpet bombing. All right. So they have a blueprint. I'll admit, it has some promising elements. But a blueprint is just a piece of paper. To build anything real, you need steel, you need concrete, and most importantly, you need cash. Cold, hard cash. Given the $40 million loss and the declining EBITDA we just talked about, the big question is, can they even afford to execute this plan? A strategy without funding is just a fantasy. So now we need to look at the financial engineering behind this proposed rebuild and see if the numbers actually, add up. And this is the number that made the entire market sit up and pay attention. Management didn't just give a vague promise of future improvement. They put a hard, specific number on the table. They are officially guiding for more than $100 million in free cash flow in fiscal year 2026. Now, for those of you who don't know, free cash flow is the cash a company generates after accounting for all the capital expenditures needed to maintain or expand its asset base. It is the ultimate metric. It's the money you can use to pay down debt, buy back stock, or fund new stores without having to go hat in hand to the banks. This is the ultimate goal of the entire Back to Basics plan, to turn this cash-burning machine back into a cash-generating one. This is their North Star. Right, and here's where the math gets really fuzzy for me. How does a company with declining sales, a $40 million net loss, and sputtering EBITDA suddenly pivot to generate over $100 million in free cash flow? It doesn't make sense. On top of that, they're also promising to spend up to $200 million on capital expenditures. That's the money for the new games, the store remodels, and for opening 11 new locations. It seems like a complete paradox. They're telling us they will spend less but invest more, all while generating a massive amount of cash from a business that is currently losing money. Let's be specific here. They just posted a $40 million loss. To get to $100 million in free cash flow, they need to find a $140 million swing in profitability and cash generation. Where specifically does that come from? Something has to give here. And this slide right here, this explains the market's reaction and its management's answer to that very question. They have tied all the pieces of their plan together into a series of bold, confident promises for the upcoming fiscal year. They're explicitly guiding for positive same-store sales, growth in total revenue, and an increase in adjusted EBIT. The math that they're selling the market is basically this. A low single-digit increase in comps, driven by the new games and the new marketing, will flow down to the bottom line with very high margins. You combine that with some disciplined cost controls and a more focused CapEx plan, and you get to their numbers. Now, these aren't just hopes, these are official, forward-looking statements from the executive team. So the market heard the bad news from Q4, but it chose to listen to these promises for 2026 instead. It is trading on the belief that the turnaround plan will work and that the company can and will hit these targets. So that brings us to the final judgment. We've inspected the structural damage from the earnings report, and we've analyzed the blueprint for the rebuild. We've heard all the promises and all the skepticism. Now it's time to weigh all the evidence and deliver the final iron financial verdict. Is this company actually built to last, or is this whole turnaround plan just a house of cards waiting for a gust of wind? Let's lay it all out, point by point, head to head. The bull case, the case for the rebuild, is that the food and beverage growth of 7% proves that the back-to-basics strategy can actually work. But the bear case argues that the core amusement business, which is the real reason people go there, is still weak and it's still shrinking. The bulls will fire back and say that the new game pipeline, packed with major IPs, is the specific catalyst that will fix that weakness and drive traffic through the door. Yeah, but the bears will counter that reversing 6 years of neglect won't happen overnight, and there's immense execution risk in a multi-part turnaround like this. I mean, one slip-up and the whole thing could just unravel.
The bull case then points to that clear, aggressive target of over $100 million in free cash flow as a sign of management's unwavering confidence. And the bear case screams that it is absolutely reckless to be pursuing new store growth and spending all that money on CapEx when your existing stores have negative comps and your overall profitability is in the red. You have to fix the foundation before you start building an addition to the house.
So the crucial point is this. This brings us right back to our original question. Why did the stock go up after such a terrible report? This slide really illustrates the answer perfectly. The market, at least for now, is choosing to completely ignore the ugly reality of the fourth quarter. It's looking past the current awful performance and it's betting entirely on the successful execution of the blueprint. It is not pricing the company as it is today. It's pricing the company as what management promises it will be a year from now. It's a classic bet on the jockey, not the horse. The market sees a construction site with a really promising architectural drawing, not a condemned building that's about to be demolished. Which, of course, leads us to the final critical question that every single investor has to ask themselves right now. Is this a rare opportunity to invest in a turnaround story on the ground floor before the results are obvious to everyone else? Or is this a classic value trap, where the blueprint looks great on paper, but is ultimately being built on a foundation that is just too weak and too faulty to ever support real sustainable growth? The answer to that question will determine whether early investors are rewarded for their foresight or if they're punished for their optimism. And here it is, the iron financial verdict. This is a high-risk construction zone. There are definitely signs of progress and a clear plan, but the risks here are immense. That's right, the blueprint management has laid out is promising, but the actual foundation of the business, which has to be positive same-store sales in its core amusement segment, remains completely unproven. The plan is theoretical until the numbers prove that it's real. Therefore, we see play as a speculative opportunity, but only for investors with a very high tolerance for risk. A truly durable investment has a history of consistent, proven cash flow. This is a bet on future cash flow that has not yet materialized. It is not, at this stage, a durable, long-term investment suitable for a conservative portfolio. And this is the final thought that we're going to leave you with. Management has presented its vision, they've drawn up the plans, they've made the promises, and for now, the market has given them the benefit of the doubt. But now comes the hard part. The PowerPoints are over, the conference calls are done. Now they actually have to do the heavy lifting. The coming quarters will reveal whether this back-to-basic strategy can truly rebuild Dave & Buster's into a powerhouse, or if it will all come crumbling down. For this stock, from this point forward, the execution risk is everything.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.